Retirement accounts have experienced losses. With the market downturn of 2008 and early 2009, retirement accounts may have suffered deep market losses. Converting these accounts to a Roth IRA while values are still low will result in less income tax reported and position these accounts for tax-free growth when the markets recover. Concern of Social Security benefits being taxed. As we discussed earlier, up to 85% of Social Security benefits may be included in taxable income. Income from the Roth IRA is not included when calculating whether or not Social Security benefits are taxable. You are in a low income tax bracket. With current market and economic conditions, some investors may find themselves reporting significantly less income on their federal tax return. A Roth conversion will generate current income to take advantage of being in a lower relative tax bracket. Also, some investors may be able to offset income from a Roth conversion with other portfolio or business losses. While Roth IRAs can certainly provide benefits for retirees, they also are a useful tool when it applies to planning for your estate. As we mentioned earlier, distributions from a Roth IRA are not required until a non-spouse beneficiary, e.g., son or daughter, inherits the account. This preserves more assets for future generations. When a non-spouse beneficiary inherits a Roth IRA, distributions from the account must occur each year, but they can be withdrawn incrementally based on the beneficiary's life expectancy. And the income is free from federal income taxes, although the value of the Roth IRA at death is included in the deceased account owner's estate for the purpose of calculating estate taxes. Although paying taxes immediately on assets converted to a Roth is an adverse factor to consider when making the decision, the act of paying those taxes does reduce the overall size of one's estate. Let's further examine the potential of using the Roth IRA to leave a legacy for future generations by comparing the results with a traditional IRA. Here's an example that illustrates the benefits. Here are the assumptions. A couple age 65 with an IRA valued at $100,000. No withdrawals from the Roth IRA until required for the owner or beneficiary spouse. Withdrawals from the traditional IRA begin at 70.5 and are limited to RMDs. Husband dies at age 80. Second spouse dies 10 years later. The yellow represents the growth of the Roth IRA, and the blue represents the traditional IRA. As you can see, because of required withdrawals beginning at age 70.5, the growth of the traditional IRA is significantly less than the Roth IRA. Again, with the Roth IRA, neither the account owner nor the beneficiary spouse are required to take distributions from the account. At the death of the second spouse, assuming no distributions and an 8% growth rate, the Roth account is valued at $739,635.32, although the traditional IRA provided over $250,000 in taxable withdrawals in retirement. The amount left to the next generation, $238,110, was $500,000 less than the Roth IRA. Daughter, age 60, inherits the account and takes distributions until she dies 15 years later at the age of 75. Now let's examine the results when the IRA account is passed on to the next generation, the daughter in this case. Again, the yellow represents the Roth account while the blue represents the traditional IRA. From the previous slide, you will notice the different starting points for each account. That is, the amounts left to the daughter as beneficiary, approximately $740,000 for the Roth account and $237,000 for the traditional IRA. In the case of the traditional IRA, the daughter must continue the minimum distributions, but she can base them on her life expectancy. Because of her age, 60, and the corresponding IRS life expectancy tables, her minimum distributions will be less than the last minimum distribution of the original remaining spouse. The shorter the life expectancy, the larger the amount of the RMD. In the case of the Roth IRA, since both spouses have died, minimum distributions must begin for the first time. As with the traditional IRA, the beneficiary daughter can take RMDs based on her life expectancy. The daughter continues taking RMDs until she dies 15 years later. The grandson of the original owner inherits the account and continues distributions until the account is exhausted. The son continues RMDs based on his mother's distribution schedule. Note, upon inheriting the IRA, the grandson cannot recalculate RMDs based on his remaining life expectancy. He must continue taking distributions per IRS tables based on his deceased mother's, the original beneficiary's, life expectancy. Now let's compare the results for each case. Traditional IRA. The account provides $760,087 in taxable withdrawals for the beneficiary daughter and her subsequent beneficiary son, the grandson of the original account owner, in addition to the $252,653 in taxable distributions for the original account owner and beneficiary spouse. Over the entire period, the traditional IRA generated a total of $1,012,740 in taxable withdrawals. Roth IRA. The account provides $2,361,033 in tax-free withdrawals for the beneficiary daughter and her subsequent beneficiary son, grandson of the original account owner. Converting traditional IRA assets to a Roth may yield significant benefits down the road. However, there are many considerations that should apply to such an important financial decision. Does partial conversion make sense? If you find that converting your entire traditional IRA to a Roth IRA creates too large a tax burden, you may want to consider a partial conversion. A partial conversion may allow you to avoid being pushed into the higher tax bracket by the amount of taxable income that would be generated in a full conversion. Taxpayers need to consider the effects of additional income generated from converting IRA assets to Roth IRA. For example, an increase in adjusted gross income may cause Social Security benefits to be more taxable, negatively impact itemized deduction like medical expenses, result in phase-outs for deductions of personal exemptions, disallow certain tax credits. Do you have assets available to pay the taxes? Taxes on the pre-tax funds and earnings will be due in the same year in which the conversion takes place. You should have funds available outside of a retirement plan to pay these taxes. Otherwise, you will be likely forced to use some of the assets in the traditional IRA to pay the taxes, which could trigger an early withdrawal penalty on those assets and create an even greater tax burden, as well as decrease the amount eligible for tax-favored accumulation over time. Do you expect to be in a lower income tax bracket in retirement? If you expect to report less income in retirement, converting to a Roth IRA may not be the best strategy. Why pay higher taxes now by converting to a Roth IRA when you expect to pay less taxes in retirement? For example, maybe you expect to stop working in retirement or choose to work part-time. Or you plan to move to a state that has a lower or no state income taxes. There may be a variety of factors which need to be taken into account before converting traditional retirement assets. The decision whether or not to convert to a Roth IRA is not a simple one. The most important step is to seek advice from an advisor or qualified tax professional to determine if a Roth IRA conversion strategy makes sense based on your individual circumstances. Remember, it is not an all-or-nothing decision. It often makes sense to work with your advisor and tax professional to determine what portion of your traditional IRA assets to convert to a Roth. He or she could discuss your specific situation, as well as recent changes in the tax law, and how you can take advantage of them as you prepare for a secure financial future.